Now, what I want to do is go through 7 points. I'm going to compare them first for the US dollar and say that we're on the cusp of hyperinflation. And then I'm going to compare these 7 points to the euro and see whether or not the euro is also on the cusp of hyperinflation. First of all, gold breaks above $1,000 an ounce. This is significant. Gold is the canary in the monetary coal mine. It's chirping. And even if people don't understand what's going on with the currency, even if they don't really understand what policymakers are doing, it's a warning sign. And people are going to be moving increasingly into gold because of the risks that they perceive, even if they don't understand yet what's actually happening. And this is a worldwide warning sign. Crude oil, commodity prices are rising. They're not rising because of good economic conditions. They're rising because of problems with the money. I travel quite a bit, and I see this particularly in the Middle East and in Asia. There are people out there who would rather own $1 million worth of copper than have $1 million sitting in a bank account. Because they say at the end of the day, they can take that copper and do something useful with it, but the dollars, they don't earn any interest income. They're concerned about the counterparty risk, the risk that the bank where those dollars are deposited might go under. So they're basically saying, why hold dollars? Own tangible assets instead. So prices of commodities are going up, not because of good economic conditions, but because the problems with the currency. Negative real interest rates. If you put $100 in your bank account on January 1st, at the end of the year you might have $101, but in terms of purchasing power you may only have 93 because of the debasement of the currency. You are not staying ahead of the game when you actually hold currency. You know, if you are earning 8% on a deposit, you have to think twice to give up that 8% to hold gold instead. But when interest rates are so low and central banks around the world are pursuing a zero interest rate policy, you have to think, well, gee, I'd rather own gold and be safe than have dollars and take a risk. Next one, blind faith in Federal Reserve management. And this is unbelievable. You know, Milton Friedman wrote a book in the early 1960s called The Monetary History of the United States. It's accepted by everyone as the Bible of American monetary history. And in that book, he explained how the Federal Reserve screwed it up in the 1930s and made the situation much worse than it would have been had they not been involved in the market. Despite that, despite the fact that 2.5 years ago, Bernanke was saying the subprime housing crisis was going to be, quote unquote, contained. Despite these things, we still think that he's going to get it right and remove the punch bowl before inflation becomes a problem. Don't take blind faith just because they say they're going to do it on television. Look at the record of what they're actually doing. Stock market is rising. The Dow is not rising because of good economic conditions. The economy will not turn around until employment starts rising. And we just had a report yesterday. Unemployment now is over 10%. That's the headline employment. The U6 measure is actually 18%. We're getting near Great Depression levels. The U.S. puts a sugar coating on the headline number and only shows the people who, what they say, have given up and are no longer looking for a job. But if you look at the total number, it's closer to 18% unemployed. The stock market is rising because too much money is being created. And if you look at hyperinflation examples in history, one of the sure signs that you're in the early stages of a hyperinflation is when the stock market rises in the face of bad economic conditions, because what people are doing is they're trying to get out of their dollars, they're trying to get out of financial assets, and if you own the stock of a Newmont Mining or an Exxon or things of that nature, you're better off than holding Australs or US dollars. Runaway US government spending. I showed the chart, that widening gap. There's absolutely no sign that policymakers in Washington, D.C. are anywhere close to changing that policy. So you have to assume runaway U.S. government spending is going to continue, and runaway government spending is always the cause of hyperinflation because the government is spending more than the market is willing to lend to it. The central bank steps in, buys that debt, turns it into currency. And seventh one is the demand for the dollar is falling. This is a key point. The demand for the dollar is falling internationally, and I think it's now starting to fall domestically. And at the end of the day, it's a flight from currency. It's a drop in the demand for the currency. that really causes a hyperinflation. Yes, the supply can go up, but the supply goes up because the central bank has to be more active in giving the government the currency it needs because the demand for the currency is falling. And that's exactly what we're seeing now internationally for the dollar, and I think it's beginning domestically for the dollar as well.